is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, everyone, and welcome to another episode of DeFi Decoded. My name is Andrew Young, and I'm joined by a very special guest this week, Hart Lambur. He's the co-founder and CEO of Yuma. Yuma is a decentralized financial contracts protocol built to enable universal market access. Hart started computer science before working as an interest rate trader at Goldman Sachs throughout the financial crisis. In 2013, he co-founded Openfolio, a personal finance tracking platform that was acquired in 2017 by a financial planning firm. He now leads a team of financial contract and Oracle design researchers at Yuma. So I'm very excited to have Hart on today. And I guess I would just open it up with sort of given your traditional finance background at Goldman Sachs, how did you get involved in the crypto space?
Yeah, well, Andrew, thanks for having me here. By the way, are we going to tell the audience that we went to high school together, or we went to the same high school?
Oh yeah. I guess you're right. I should say that.
I'm a bit older than Andrew for the audience, but we actually did go to the same high school in Toronto, which is kind of fun. But to your question, like, how did I get from Goldman to crypto? I do owe credit to Fred Ursum, who I know from Fred Ursum, the co-founder of Coinbase, and now one of the partners at Paradigm, a big VC fund in the space, who I know from my Goldman days. So he's the guy that first told me about Bitcoin. We're buddies from before he started any of that, and so he's my entry point, and I'm very lucky to have had him show me the way. But then, generally speaking, I think the broader observation here is that I come from a background where I studied computer science, never expected to work in finance at all. I actually only worked in finance because I needed a visa to stay in the States as a Canadian, and Goldman could get me one. And crypto to me is this super interesting intersection of computer science, finance, economics, probably psychology. And that's really what I got drawn to, purely out of my own interests.
Yeah, that's it is interesting to see, because I'm also a sort of a refugee of the traditional finance system. I used to work on the trading floor of Bank of Montreal, so I totally I sort of came to it honestly as well, from just getting very interested. For me, it was actually my co-founder Alex who got me interested in the space. But yeah, it's kind of interesting to see so many people from the traditional finance space go into the crypto space, and then you're not seeing anyone else go the other way. So,
yeah, I mean, to like, it's very true, because I actually do have a lot of my traditional finance friends. So more background on like what I did at Goldman. So I started at Goldman in 2005, where I was an interest rate trader. And rates trading back then for 2005, 2006 was pretty boring. And then it got really interesting through the financial crisis, like 07, 08, 09, 10, 11, 12. And then it got really boring for a while. And like what you've seen is like there was an era there where I think trading and finance was in a growth time, and now it's not. And the amount of people or interest I have from TradFi people that are like traditional finance people, they got into trading or they got into finance because a lot of them are really curious about markets, really curious about incentive structures, really curious about, frankly, technology. And now I think the whole space sees DeFi as this amazing growth area, a real way to like stretch their wings, kind of the future. And you're right, it's become this huge draw where you just got this one-way flow of real intelligence flowing into this DeFi space. It's no longer a toy, it's no longer a joke. I have big deal partners from Goldman Sachs want to ask me about this DeFi thing. And I think that's kind of cool, kind of a sign that we've actually built something meaningful.
Yeah. And it's great too. I think it gives sort of crypto a huge recruiting advantage because at least I see it myself. Like it's a space that people really want to be in, both from sort of the traditional Web2 space, but then also traditional finance. And so I think it's a huge competitive advantage, and sort of just is another one of those tailwinds that crypto has been getting. So can you tell us a little bit more about how and why Yuma was founded, and what are the problems that it aims to solve?
Totally. And there's a long path here, so just like interrupt me if I start wandering too far. The thesis, or the sort of the genesis idea, and this is back in early 2018, before DeFi as a term existed. The genesis idea is that smart contract platforms like Ethereum should be a great way to write financial contracts. And if we write financial contracts correctly, we can create a mechanism to transfer risk universally, that's universally accessible. And so the other points here is that, okay, wait, let's look at the history of finance, the invention of like a derivative, like a swap contract, a total return contract, or whatever, any type of like that sort of financial contract was a big deal, super useful, and it let people make bets to hedge risk all over the place. But the enforcement mechanism for those types of financial contracts was the legal infrastructure. So it's like, hey, if we enter into some sort of swap agreement, if anything goes wrong, sure, there's margining and there's some collateral, but ultimately our ultimate recourse is that I know who you are and I can go and sue you. And that actually worked great for most of the Western world that has access to that type of infrastructure, but it's fundamentally not global by nature. And then you go and you look at the internet, which is this other like paradigm where everything's global by nature, where people like, it doesn't matter where you are. And you're like, well, these two things don't intersect. Finance is actually hilariously siloed and regional. The internet is global. Crypto, and then being able to write financial contracts that are enforced anonymously, where you don't need to know who somebody is, it's just enforced through economic incentives, seemed like a way to write universally accessible financial contracts that could be accessed anywhere. So that's kind of the genesis story. So we're like, hey, let's figure out how to write contracts for payouts that anyone can access anywhere.
So, and I mean, I know the Yuma project obviously really well. So, but to me, it's always been really interesting. It's almost like a decentralized dispute resolution system, and almost like the crypto version of like a settlement layer for disputes, and almost like a legal. I always think of it almost like a regulator in a way. And I mean, I don't know if that's the right sort of thing to think about.
I like it.
But and then what's interesting is it's like you've also created sort of contracts for people to use that then uses the Oracle. Can you tell me a little bit more about how sort of the optimistic Oracle is designed, and how does it sort of work without getting too technical?
Yeah, totally, Andrew. We'll keep it high level, but like to back up even for a second, Ethereum itself is supposed to be a smart contracts platform. So if I tell you, hey, we're trying to write contracts, you'd be like, well, just use Ethereum for that. That makes sense. The difference here is for the types of contracts we're interested in writing, we need information that doesn't exist on the Ethereum blockchain natively. Like like what the price is of something, or who won a basketball game, or whatever it might be. There's some bit of data that doesn't exist. It's called the Oracle problem. A lot of people like spend a lot of time on this. There's a project like Chainlink is very successful in solving the Oracle problem in specific ways. So they write data to the blockchain that says this is true, right? But they only do that for specific types of data that are kind of popular, let's put it that way. For us, we're trying to solve this other problem of getting data to the blockchain that's arbitrary. How can we get any bit of data that is verifiable, but like is totally unrestricted in terms of what you can ask? And the concept here, which we call our optimistic Oracle, is really actually quite simple, where we can ask the optimistic oracle any knowable question, like who won the basketball game, who won last year's Super Bowl, whatever we can know, and we let anybody respond to that question. If that response then has a challenge period, it has a delay in it, where if nobody disputes that answer in that challenge period, it's accepted as truth. Whereas if it is disputed, it gets escalated to all the UMA token holders who ultimately vote on whether it's right or not. And so we call this like an optimistic oracle, because in the optimistic case, we don't actually need to ask our token holders anything. It's just the person that proposed the answer proposed the right answer. It's only in the disputed case that we have to do a bunch of work. And the one I just add that the analogy here is actually like looking at the traditional legal system, where in the traditional legal system, you and I could write a contract, like a legal contract between us, where we optimistically hope we don't have to litigate it. We hope we don't have to sue you and go in front of a judge or something like that. It's only in the pessimistic case where we fail to agree that the contract was followed that we go and we litigate things. And that threat of litigation is what enforces us to do the right thing. And our Oracle system works the same way. The threat of having to go to this broader dispute mechanism is what keeps people honest initially.
Yeah, no, and I think that's awesome too, because it's much lower, because it's obviously very costly every time you have to involve the UMA token holders as a backup. And so by essentially using the threat of that, you don't actually have to go to them every time. And that's why I always thought the design was pretty smart. It just kind of it sort of works without actually having to without having the UMA holders sort of bear the full cost of it every single time, which is sort of different than how stuff like Augur back in the day was designed, and sort of other decentralized oracles. So UMA has been extremely successful. It has over $100 million in TVL. What are some of the projects that are using UMA nowadays?
Yeah, so back when we started this too, we wanted to figure out a way to showcase how this Oracle system worked, and also showcase its flexibility. So early on, we spent a lot of time around what have become known as synthetic assets. So writing contracts where it's a contract where there's a token that gets spit out of the contract, and that token is supposed to track some index. And we did this back in the day because we really wanted to showcase the breadth and flexibility of this sort of Oracle design, and showcase how we could write really flexible financial contracts. What we've actually is, and so there's a bunch of examples of this that are out there, and contracts that track the value of a CryptoPunk, or track the average gas cost on Ethereum, all sorts of like really fun stuff. What we've actually found a lot of traction with, though, more recently, is something we call like KPI options. And this is really specific to the rise of DAOs and all these other token projects that sit on a bunch of the project token and want to incentivize some action amongst their users. And what we realize is this is a great use case of a financial contract, but a very flexible type of financial contract, where I create a contract with a synthetic token, in this case, a KPI option, and that token will pay out some number of project tokens depending on whether some KPIs are hit. And so we've seen a lot of different crypto projects use this design to create KPI options to incentivize some behavior or action that they want their users to do. Like, we want our TVL of our project to go up, and if our TVL hits this target, we all get a bonus, things like that. And it's been really cool to see this sort of incentive structure take off, this incentive structure design pattern take off, where people are using these in a lot of creative ways. They're using them for like to finance an acquisition of another protocol, things like that. And it's been pretty fun.
Yeah, no, totally. And DAOs, so everyone sort of understands, according to this website, Open.org, they have over $10 billion in their treasuries, but about 95% plus of those treasuries are denominated in their own native token. And so there's been a huge push recently towards sort of treasury diversification. And I think I actually saw someone proposing using Yuma for Sushi Swap's sort of treasury diversification plan, because essentially what a treasury diversification is, it's almost like it's essentially just DAOs selling tokens out of their treasury for stable coins or ETH to sort of obviously diversify their treasury. But it can be very contentious because you're essentially typically selling tokens at a pretty big discount to the market price to sort of traditional institutional investors in crypto VCs. And so what's really cool about the KPI options is you can essentially allow people to get this treasury diversification, but rather than selling a huge chunk of tokens at a discount, you essentially sell these KPI options, get the premiums, and then if the price hits sort of these milestones, like higher than what the current market price is, then they would execute and get the tokens that way, which to me is just a far more aligned and sort of more intelligent design than just a simple lockup plus discount model. So I do think that obviously DAOs have just kind of come onto the scene over the last year. So I think it's a really, really cool, it's almost like employee vesting options in a way, but for investors. So I think that's, I'm just very excited about that idea. I guess switching tacks a little bit, how do you see the DeFi ecosystem developing over the next year? I think there's been a lot of stuff with DeFi 2.0, with Olympus DAO, and then there's just been obviously new protocols coming out every single day. I'm just kind of curious, what are your big narratives for DeFi over the next 12 to 36 months?
Oh, $1 million question, right? And this is where I'm going to ask your opinion too on a lot of this. And I think there's a bunch of observations. So DeFi was a total toy, certainly 2 years ago, kind of a year and a half ago. And that toy very quickly became not a toy anymore, where people realized like, okay, Compound and Aave, these lending protocols have billions of dollars locked in them. Uniswap does more volume than the really big centralized exchanges, and Uniswap v3 ends up being entirely very capital efficient. All these huge milestones get hit to prove that DeFi is a thing. And now DeFi has actually kind of been, if you want to be like a little market driven around this, DeFi's underperformed NFTs and other things in the crypto space pretty significantly over the last like 6 months. And I think it's interesting to think through like what that means and then what the DeFi 2.0 thing is trying to do and where does this all go. So I'll just make like being kind of caveman stupid about this. DeFi has proven that you can do lending and borrowing, you can do trading, you can do derivatives of different types. And all those milestones are proven and they like, quote unquote, like work. Now I think we need to figure out use cases that build on top of that. And I think my narrative for the coming year, maybe it's a couple years, is that all of these other crypto use cases, all the NFT and Web3 stuff is going to end up demanding kind of like financial solutions to power them. And so what we're going to see is like, just like finance is supposed to support, quote, like real businesses in doing things, I think we're going to see DeFi support end user applications like the DeFi, the play to earn stuff, the NFT, the play to earn stuff. We're going to see these other applications. DeFi is going to end up supporting them in use cases we can't even quite imagine now. That's like my very generic or very high level answer.
Yeah, I think that makes a ton of sense to me. It's always been very weird with crypto because the financial system in a lot of ways is supposed to be kind of like the brain of the economy. And what I mean by that is it's sort of there to allocate capital to in the most efficient way to other areas of the ecosystem. And what was weird with DeFi and crypto is that we just developed the financial system first and had no actual sort of industries with real use cases yet. So it always seemed a little almost backward in a lot of ways. And so I think it makes sense that now that the brain, to use my analogy, is developed, the rest of the body is going to be sort of developed along with it. And I think you're probably right in the sense of like the thing I always talked about was like something like Decentraland, which is essentially allows people to buy digital land in the metaverse. We saw like a little bit of this back in the day. There was people creating like mortgages to be able to actually buy this land. But for the most part, it hasn't really interacted with the broader DeFi ecosystem, besides like a couple sort of little experiments here and there. And I think like the development of the play to earn, the digital, like the metaverse, we're finally starting to get some like real use cases that are going to have tons of users that can then sort of interact with DeFi in a really, really cool way. So yeah, I mean, I definitely agree. I think that's a pretty, yeah.
Yeah, I mean, riffing on that, Andrew, like I think that's kind of exactly right. Like, we built this DeFi financial thing it was very self-referential. It's like, I'm gonna go and like borrow against a DeFi token to buy more of a DeFi token to trade it for another DeFi token. It's just like very self-referential, right? Which I think is totally fine and prove the pipes. And your Decentraland example, I think, is really good. It's like, oh, wait, if I had some NFT or some other digital asset that I wanted to borrow against, that makes sense. But now putting it together, if the Decentraland grows to be huge, if we've got an NFT economy, if we've got $100 billion of NFTs locked up, all of a sudden now you have real demand for financial solutions to borrow against those things, use them as collateral, like you now have like a kind of quote unquote like end user use case for some of this DeFi stuff that ceases to be quite so self-referential. So now you like use the DeFi protocol to borrow against your NFT or Web3 asset to then go trade it for some other NFT or Web3 asset that lets you do something you want to do. That makes a lot of sense.
Yeah, no, just like like whenever I explain DeFi to someone like my dad, for example, they would just be like, you're essentially just buying shares in an exchange on that exchange. Like it doesn't make any sense. Like it's just one big circular economy. But yeah, no, I think that's very interesting I do think that actually makes a lot of sense. Like there's almost going to be like organic needs for these financial solutions rather than sort of starting with the financial solutions looking for a problem.
Yeah.
I think one of the big things too we're starting to see is kind of across the whole industry is there's like a major rethink of tokenomics because like you mentioned, a lot of the sort of DeFi 1.0 protocols have sort of severely underperformed ETH over the last year. And a lot of that was due to sort of kind of like a spray and pray liquidity mining customer acquisition strategy, where everyone was just essentially giving people effectively paying users to use their projects, which is good because in a lot of ways, like there's huge network effects to all these things. And so by paying people at the start, you can kind of help bootstrap the necessary capital to get the network effects going. But it has led to a lot of tokens doing pretty poorly. And so I think one of the things I'm kind of interested to see is like a more of a focus on value capture and sort of more sustainable tokenomics models.
Let's talk on that though, because I think it's like for your audience and all that, I think it's super interesting, like this DeFi 2.0 thing. And frankly, I wouldn't mind getting some of your views on this too, where a lot of the DeFi 2.0 thing, and we'll talk about like Olympus and there's a balance here. Some people label elements of these protocols as like Ponzi schemes. And I use the word Ponzi or Ponzi game. And I use this very, I don't want anyone in your audience to yell at me because I'm actually think there's some really interesting experiments going on in here. I think some of there's some interesting things to be learned. And then there's also this concept of like excess that we see in crypto, that everybody always takes things like a little bit too far. And when you take things a little bit too far, the wheels come off in some way, shape, or form. The tokenomics stuff is super fascinating because like, my views on this again, like be caveman stupid. End of the day, there has to be some value to this token. There has to be some real way of why this token has some value. That everybody will say that makes sense. However, being creative about how you get there can be real innovation. And that's also traditional finance, right? Like, you know, take venture capitalists or whatever. You go and venture capitalists buy some shares in some private company that are completely valueless, like that. Wait, they're just some promise in the future that this thing may figure out a way to do something of value. So, or do something that justifies value. So I think that a lot of the liquidity mining and the DeFi 2.0 stuff, these are really interesting mechanisms to distribute ownership, to like let a community have ownership over a network in a way that could actually set the protocol up to be successful and like create real value at a later date. So I'm like super intrigued by all these examples. And I think the fact that DeFi lets us iterate on these designs like so damn quickly is probably one of its biggest strong suits, which means all these experiments get run super fast. Many of them will fail. Some of those will fail horribly, but there are still like insights learned along the way. And I want to be like super positive around all this like experimentation where the speed at which we're able to run experiments means we get insights faster. And I find that like super exciting.
Yeah, no, I totally agree. And I think one of the coolest parts about it is obviously everything's open source. And so once someone creates something new, you get like 10 forks of it. So 10 copies with like slight parameter changes. And so you get sort of crazy experimentation right away in all sorts of different directions. And you're able to kind of learn from what other people are doing in real time without sort of bearing the cost, hopefully. I think on the DeFi 2.0 stuff, I agree with you. I'm very intrigued with it. I think with Olympus, one of the things that they sort of went after the biggest use case first, which was kind of like a reserve, I guess not a stable coin, but a reserve currency. But I think the DeFi 2.0 stuff perhaps makes more sense in other models where there's kind of transaction fees being generated. So DeFi 2.0, like you said, is kind of a way to accrue capital into your DeFi platform. And if you can kind of justify the dilution in the token with the fact that you're reaching this sort of minimum level of capital needed, which can then be used to sort of generate a future stream of cash flows, then it actually makes sense in a lot of ways. But it is a more capital heavy model versus sort of DeFi 1.0, which is very capital light. What I mean by that is like something like Compound doesn't own all of the capital on its platform, which likely, I mean, to think about it in a different way, it means you might be able to get sort of lower cost of capital because you don't need that much dilution in order to get the same level of capital as something like Olympus, which has to essentially buy all of it on the open market. So it's tough to say, really. It's kind of two different models. It's capital light versus very capital heavy. And I could see a lot of the DeFi 2.0s almost developing into almost like a sort of bank, which just has a huge balance sheet and then sort of wields that in a way that generates returns for its token holders. Whereas sort of the DeFi 1.0s are more of like a tech platform, like almost like a two-sided marketplace. But yeah, I mean, it's tough to say really what's going to happen.
Yeah, no, it's like, so the DeFi 2.0, the way I look at it is you're buying everything in kind, like to use a traditional finance term, right? So I'm going to buy everything with this thing I created, my project token. And I think what happened here is like, there's actually some really fascinating innovations here where it's like, if my project token is worth $100 and I'm going to buy $95 worth of ETH for one of my project tokens. It's like, okay, well now I have something worth $95, and I kind of paid the market $5 for this. This is sort of what Olympus did, and like I think that's actually kind of cool if I want to accumulate this huge treasury. Where things go wrong though is if my token is trading at like some huge multiple to the assets I actually have. And then all of a sudden sentiment turns and they're like, wait, I'm paying, I'm giving you $90 of real ETH for something that only has like $10 worth of ETH in it. I don't want to do that anymore, right? And again, everything in balance. So I think that this is just one of those things that DAOs end up, I think the idea of a DAO, a crypto project holding a huge amount of assets is super fascinating and makes sense in a lot of use cases. But like valuation does matter at some point, I guess.
Yeah, exactly. There's gravity with a lot of these things, right? So I guess to me, it's kind of interesting is, does it get enough capital, which then justifies sort of future fees, which then can justify the token price. But yeah, I mean, it's hard to say. One thing we've been hammering on a lot on this show is this idea of a multi-chain world. And we've talked a lot about how sort of Ethereum's market share of DeFi has gone from 100% to about 65%, around even 60%, and seems to continue to go down. There's obviously a ton of new chains, sort of first with BSC and Polygon. Now we're seeing all of these layer twos come out, Solana, Avalanche. How do you think about sort of this multi-chain world, and how are you positioning sort of Yuma for it?
Yeah, I think that this idea of there being one simplification, and like both can be true, but one simplification is, do we have a multiple L1 world? So do we have Ethereum, Solana, Avalanche, others, and we're moving between them? Or do we have a multi L2 world that's actually like primarily secured by Ethereum, and then you have a whole bunch of L2s that they're kind of all these L2s are synced with Ethereum, and you're moving between these L2s, right? The answer is you probably end up having both, but I do think the simplification is useful to think about where Ethereum goes. So for the audience, the users, like what an L2 means in this context is that you have another sort of chain. It's like it's kind of, you can almost think of it like it's its own chain that's secured by a parent chain. And in this case, the parent chain is usually Ethereum. So it's kind of like checked into or synced with Ethereum, would be like one way to think about it. And it's a way that you could, at least in theory, get massive scale out of Ethereum, where you have all these L2s that are checking into it. The thing I like about an L2 centric world, where we have all these different L2s, is there is sort of like one source of truth. Like everything is ultimately secured by this one place, and there's sort of like one global settlement layer for everything, which I think is conceptually nice. The multiple L1 world means you have these different settlement layers, and then you have to communicate between them, which can be done, but I think it can be messy too. I don't know if that fits with your view, Andrew. I think you're pretty pro multi-chain from what I know from our conversations, and have been that way for a long time. I think I'm probably more in the camp of like, I like a lot of what's happened in the Ethereum ecosystem. So I'm kind of like biased pro Ethereum. And I think that there are nice advantages to having like a really truly single like global settlement layer that make a kind of L2 centric world marginally more appealing to me. That doesn't mean it'll happen. I don't know. What's your take on this? What's your update?
Yeah, no, I think I'm obviously more multi-chain, I would say. So the way I sort of think of them is each L1 is almost like its own sovereign nation. And then the L2s are almost like different provinces within like the sort of inherent sovereignty from the base layer. And so I think, and sort of, we saw this over the weekend, like what we'll call free trade across L1s, i.e. bridges, are very fragile. So Wormhole, for anyone that doesn't sort of paying attention to crypto Twitter, Wormhole, which is a bridge between Solana and Ethereum, got hacked for about $325 million. That hole was then plugged by, I believe, Jump Trading, who sort of operates the bridge, and could have been really, really bad, but luckily it sort of was bailed out. And so there's a lot of security issues with sort of having all these different bridges. At the same time, though, I do think that there is sort of almost like secular exponential demand for block space. And so I don't know if, to me, it just seems likely that the solution to that is sort of a multi-chain world with, and some of the bigger sort of multi-chain worlds also having their own sort of layer twos on top of them. So that's kind of my thesis. I do think another thing I think about also is how like Ethereum to me is by far the most secure and decentralized smart contract blockchain. The next wave has been very scalability focused. So Polygon, BSC, Solana, Avalanche. And I think the next wave after that is going to be almost like industry specific use cases. Some people call it app chains. I call them almost like industry specific chains. So things like Ronin, which is for play to earn, Osmosis, which is for DEXs. We're building SX network for prediction markets. So I think that's going to be another big trend. You also see it with like Compound, which is trying to build compound chain. So I do think that's potentially a next wave as well. But yeah, I don't know how it's going to play out. And I think for someone like Yuma, which is, I would classify it more of like middleware than sort of straight consumer facing, which is great. It means it's sort of fundamental technology across a number of different chains. It's sort of positioned well for in either scenario.
Yeah, no, on that point, Andrew, like our architecture works really well in any of these worlds, because if we go back to this optimistic Oracle idea, in the optimistic case, we don't need to leave that chain. So, or that L2 or whatever else. So for example, if we have our Oracle deployed on a whole bunch of L2s now and on Polygon and increasingly on like other like L1s too. And so if you go and you ask the Oracle a question, you ask the Oracle a question on, let's just say Solana, somebody proposes an answer and it gets accepted, and it's not disputed, great, no need to leave Solana. We only would need to go to our UMA token holders, which by the way, could be like an app specific chain or an industry specific chain in a future world too. We only need to go to our UMA token holders when there's a dispute, which is super rare. So this sort of solves a lot of, the architecture fits really nicely in this multi-chain world where the difficult thing, which is moving between like chains, we have to do very rarely. It's only the threat of being able to do this that matters. And I think that's kind of cool.
Yeah, no, for sure. And I think one thing, so right now, like the tokens, I guess just a quick clarification. If a question is initiated on Solana, is it answered on Ethereum?
Yeah, so we don't support Solana right now because it's programmed in Rust and it's different environments. So maybe a bad example, but let's take Polygon, for example. which is sort of a side chain. If you go and you ask the optimistic oracle a question on Polygon, and it's disputed, then that dispute gets bridged back to Ethereum, where the UMA token lives, and the UMA token holders vote on whatever the right answer is for this dispute, and then that answer gets bridged back to Polygon. And so we can do this actually really effectively. We've deployed the optimistic oracle. Officially, we've deployed it on Arbitrum, Boba, and Optimism, which are all Ethereum L2s, as well as Polygon. We have some unofficial deployments sitting in other places here too that are like I'll spare the details for the audience, but just testing them out. But yeah, disputes are super rare, and the dispute does go back to Ethereum, where the UMA token sits.
Yeah, but you could almost see long term if Ethereum doesn't scale and voting gets more and more costly, perhaps UMA will need sort of its own permanent home to sort of house all of its liquidity.
No, and I mean, I think it's really it's interesting having this debate with you, because you and I have talked about related things for years now. But early on, before we built this, if something like the Cosmos SDK existed, and for the audience, Cosmos is like the Cosmos SDK basically lets you run your own app-specific blockchain pretty easily or elegantly. And Cosmos has been building this for many, many years. It's a pretty impressive piece of technology. If that existed when we were building UMA originally, it might have been a cool use case of like, okay, wait, we're going to have our own chain for this token. There's lots of pros and cons to that. But we're getting to a place now where blockchain technology is actually pretty cool. Like, you can do a lot of things. If you want to run your own chain because you think it makes sense, you can do that. If you want to run a layer 2 chain and tie it in with Ethereum, you can do that. So that's actually pretty exciting, and I think pretty bullish for the space too.
Yeah, definitely. I mean, there's almost too many things to be bullish about on this space. So, okay. I mean, I don't want to take too much of your time. Your time is obviously super valuable. So thanks again for coming on this podcast. If anyone wants to sort of keep in touch with what's going on with UMA and yourself, what's the best place to sort of follow you?
Discord is the best place for UMA. If you go to our website, umaproject.org, you can see all of our social media links there. On Twitter, I'm Hal2001, HAL 2001. And then Andrew, should make one more plug for, because we talked about bridges here, for a sort of an L2 specific bridge that we've built called Across, which is actually pretty new and pretty cool. And it uses the UMA's optimistic oracle in a really capital efficient way. So right now we've got the lowest fees to bridge the biggest volumes in the L2 to L1 space, because I do think this is really interesting. So one other plug, if you guys are interested in a cool bridge that we actually have 100% owned by the community, go check out Across at across.to is the address there.
Awesome. Yeah, I'm going to go check it out right now. Thanks again for coming on the show, Hart. And yeah, looking forward to speaking again at some point.
Of course, man. Great to talk.
Awesome.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.